Remember, I believe that the market is just a reflection of liquidity. If liquidity, money, is being added to the market, that means it's probably going to go higher. If it is being removed from the market, it's probably going to go lower. There are three things that combined make up the idea or can give you a very good understanding of if liquidity is being removed or added from the market. We talked about the Federal Reserve balance sheet. We talked about the general account at the U.S. Treasury. Now, both of those haven't really gone crazy so far this year. So after you watch those first two videos, you might have been wondering, well, it doesn't look like the money supply has been going down a lot. It doesn't look like the Fed's balance sheet went down a lot. And the general account at the U.S. Treasury is basically sideways this year. So where is all this removal of liquidity coming from? It is coming from, drumroll please, what you see before you. It is known as the overnight reverse repurchase agreement. Basically what happens is this. You have $10,000 in a bank account. Chase takes 8 of that and parks it at the Fed overnight. You get paid by Chase 0. The Fed pays Chase now whatever the federal funds rate is. As of shooting this video, it is between 3 and 3.25%. As of right now, the Federal Reserve pays $500 million a day of interest to banks out of this overnight reverse repurchase agreement. What you can see here before you has been the biggest drain on stocks. Nearly $1 trillion has been added since this time last year to this overnight repurchase agreement at the Fed. Basically, $1 trillion has been removed from the financial sector, from financial markets, and parked in the Fed overnight. The higher federal funds interest rates go, the more money follows this. Why? Because they pay you nothing out of your checking account, and they make a risk-free return of right now 3%, but the way the market is pricing everything, 5% by next April. So again, the Federal Reserve's balance sheet is only down $200 billion. That's not a lot. The general account at the Treasury is sideways this year, but $1 trillion has been removed from financial markets and been added directly to this overnight repurchase agreement at the Fed. So if interest rates continue to go higher, this number will also continue to go higher. Billions, hundreds of billions, if not trillions more will be added to this number. That will remove the money from stocks. Stocks will continue to go lower. So again, the Fed's balance sheet is only down $200 billion. It's not a lot. The general account at the Treasury is sideways, but $1 trillion, $1 trillion has been taken out of financial markets by banks and institutions and parked at the Fed overnight. So this right here, what you see before you, is the reason why stocks have had such great difficulty this year. It's not because the Fed's balance sheet, my friends. It's not because of the Treasury. It is because banks are now removing liquidity from the system and parking it overnight at the Fed. Again, you get paid nothing. They get paid today 3%, but it looks like by the end of Q1, very early Q2 next year, 2023, at least the way the market is pricing in these things, that they will be getting paid 5% and they'll still pay you 0.